Welcome, everybody. Welcome to our FHA update. I'm Crystal Bise, and I will be your host today. Before we begin, I did want to remind you that if you're having any technical difficulties, you can put that in the chat box, and our staff people will just double check with you and see how they can troubleshoot with you. If you have any questions during our presentation, you can drop your questions in the Q&A box or in the chat box. And also one more reminder is that we are going to have an evaluation of this session. As soon as you log out, you'll be getting a link. So if you could please do the evaluation, we'd really appreciate it. I just wanted to also note that the Hawaii Realtors is having a few upcoming webinars worth mentioning. We are having an informational webinar next week, Tuesday, on a comprehensive healthcare member benefits program. This is a new offering of a variety of healthcare options for HER members, and Ethel is going to drop the link to register for that in the chat if you're interested in that. And for PBBICs only, we have our PBBIC Hot Topic webinar, and that is entitled Empowering Members, Uncovering the Benefits of Conflict Resolution with NAR Director Diane Mosley. It's a free webinar, and the link will also be dropped in the chat box for those of you who are interested in registering. At this time, I want to introduce our President of the Hawaii Association of Realtors, Kalama Kim, and he is going to do a little introduction for you.
Aloha, Realtors. Kalama Kim, your 2023 Hawaii Realtors President here, and I want to thank you for tuning in to this seminar today. This is part of our Virtual Connect series, which happens 4 times a year. Yes, that means it's quarterly. We do math here in real estate. Today, our topic is FHA, and we have a couple of great speakers to take you through this seminar. Let me tell you a little bit about them. They are both from the Santa Ana Homeownership Center, and they're here to share their experience from the FHA's single-family mortgage programs and other topics. So we have Director Frederick Griefer and Housing Program Officer Esther Yamashiro, Housing Program Officer. Mr. Griefer was recently named the Director of Department of Housing and Urban Development, Santa Ana Homeownership Center. Congratulations, Mr. Griefer. He brings a wealth of experience from his time in Washington, D.C., where he worked for the federal government at the U.S. Department of Health and Human Services, the Environmental Protection Agency, and HUD. He has also served as Deputy Director of SAHOC since 2019. Ms. Yamashiro has been with SAHOC since 2008 and has served in various capacities, including as an underwriter and branch chief in the Processing and Underwriting Division. She brings her extensive experience in single-family policies and programs to her current role as the Housing Program Officer. Today's webinar will provide you with an in-depth look at FHA's single-family home mortgage programs and how they will assist your clients in achieving their dream of home ownership. Please welcome Mr. Griefer and Ms. Yamamoto.
I'd like to also invite our Director, Ryan Okuhara, with Honolulu's field office with the U.S. Department of Housing and Urban Development, to say a few words right before we get in there. Hi, Ryan.
Hi, Crystal. Thanks a lot. I just wanted to introduce myself and then really kick this off. My name is Ryan Okuhara. I'm the Field Office Director for the local HUD Honolulu Field Office. Been in this position about 12 years, worked with the Hawaii Realtors Association and others over the years. This is not the first time that Santa Ana Homeownership Center has come to give us a presentation. In fact, 3 years ago in 2020, I think we had Esther do a similar session, and before that, her predecessors had done sessions here and also on the Big Island. The importance of FHA for us, I think they're going to go into much more detail, but it's an important tool for us for first-time minority home buyers, low-income, moderate income is our kind of target audience, but it's really open to everyone. I think Esther will also talk about how FHA can really help us in terms of disaster loans, after a disaster, and then really focus in on reverse mortgages for really our seniors to keep our kapuna in their housing. So with that, I'm going to turn it over to opening remarks from Fred Griefer, and then after that, Esther. Thanks a lot.
Thank you, Ryan. Hi, Fred.
Hi,
Welcome.
thank you. And I want to thank the Hawaii Realtors for providing us with this opportunity. As the director of the Santa Ana Homeownership Center, we oversee the 8 Western United States. And for me, part of the vision that I have for the Homeownership Center is that we provide outreach, both a combination of virtual and in person. And we're really privileged and grateful that Ryan has hosted us in Honolulu this week. And as this fiscal year reaches the fourth quarter, we would have visited all 8 states in our jurisdiction. And so, as I indicated, as part of my vision is that we build relationships with external stakeholders, whether it be lenders or realtor groups as well. And we're grateful to have this opportunity to be able to build that relationship, both to educate, but also to listen to you all and get insights in terms of what you're seeing on the ground and how you believe that us as the Santa Ana Homeownership Center could assist as you work to execute your vision. I would be remiss if I didn't mention that the National Association of Realtors Convention is taking place in Anaheim, which is right down the street from our office. So, and we do plan to have a booth at that event. So we definitely look forward to hopefully being able to meet some of you in person at that event. Without further ado, I'll turn things over to Esther Yamashiro, our Housing Program Officer, who will conduct the remainder of the presentation. Esther?
Thank you, Fred. Let me just pull up the presentation here. We can get started. Okay, can you all see that, I hope?
Yes.
Okay. So again, I am the Housing Program Officer at the Santa Ana Homeownership Center. And okay, why is it not moving forward? Here we go. So the Federal Housing Administration, or FHA, is basically an insurance company. You know, granted, we're the largest mortgage insurer in the world, but still, we're an insurance company. Since our creation, FHA has insured over 50 million home mortgages and currently insures over 8 million homeowners. So a simple look at how it works is that lenders collect insurance premiums from borrowers and remit them to FHA. Now, if the borrower defaults on that mortgage, the lender could suffer losses due to that foreclosure. FHA will pay a claim to these lenders for those losses. Now, FHA insurance provides protection against 100% of the losses, which is what makes FHA so attractive to investors. Now, what you may find of interest to know is that FHA is the only government agency that primarily operates from its self-generated income. Those insurance premiums we collect not only go to provide protection against foreclosure losses, FHA also uses it to fund our operations. Now, Congress created FHA in 1934, and it became part of the Department of Housing and Urban Development in 1965. So FHA is actually older than HUD. Today, FHA has active insurance on over 8 million single-family mortgages. Its combined portfolio, which includes single-family, multifamily, residential care facilities, and hospitals, equates to over 1.2 trillion in unpaid principal balances. So single-family programs, we're going to take a look at some of the reasons why a borrower may want or need FHA-insured financing. So FHA, I think, is primarily known for its flexible qualifying. Most notable, I think, is the lower minimum FICO requirements. We'll take 580 for maximum financing, and that equates to a minimum down payment of 3.5%. Gifts are also acceptable for 100% of the down payment and closing costs, and we'll do cash out to 80%. FHA also allows secondary financing, which works great with most of the down payment assistance programs provided by nonprofits and government entities. Now, one thing to keep in mind is FHA sets maximum loan limits for forward mortgages by individual county based on the median sales price of that county. The loan amount can be less, but not more than the set limit. And a full list of loan limits can be found by searching maximum mortgage limits on the HUD.gov website. Now, in keeping with our mission to create strong, sustainable, inclusive communities, our primary focus is owner-occupied principal residences. And this includes single-family dwellings, planned unit developments, condominiums, 2 to 4 units, and manufactured housing. Now, second home loans may be made, but must be reviewed and receive approval by the jurisdictional homeownership center. So for Hawaii, that would be us in Santa Ana. Specific eligibility criteria must be met with regards to second homes. And this is not a loan intended for vacation home purposes. Now, we do several non-owner occupied loans to government entities and approved nonprofit organizations in connection with their affordable housing programs. So our portfolio of loans looks like this. First up is forward mortgages. I guess you could call this our bread and butter product. We do purchases and refinance, and that's pretty common in the mortgage market. We also have property improvement loans and a disaster recovery mortgage program. So let's take a better look at the property improvement and disaster recovery programs. On the repair, rehab, or remodel front, we have our 203K loan. There are 2 types of 203K loans. The limited program, which allows up to $35,000 in minor non-structural repairs. Examples of common 203 limited K work are kitchen remodels, painting, or new carpet. Remember, these are non-structural items. Our standard program is a minimum of $5,000 in repairs up to raising the current structure to the foundation and putting up a new one. Now, I reviewed a loan early in my career with the Homeownership Center in which a borrower purchased a small, dingy, single-family dwelling. Now, this property needed a lot of love and elbow grease. The borrower had it raised to the foundation and put up 4 units in its place. And it's likely they'll never have to make their own mortgage payment with the rents they receive. And that is a fantastic opportunity. Now, the standard K requires a consultant who oversees the work. And a standard K will cover structural alterations, monetization, health, and safety issues. Now, our energy efficient mortgage, or EEM, allows the financing of energy efficient upgrades to the loan, both purchase and refinance. An energy rater is required, and the energy rater will go through the property and provide a list and cost estimate of all the potential energy upgrades to the property, along with the potential savings. The borrower then reviews this report and decides which ones they want to include. They don't have to do them all. The program allows for debt to income flexibilities due to the energy efficiencies. The lower cost of energy translates to more income that can be devoted to the mortgage payment. Now, you can use an EEM in conjunction with a 203K loan. Now, all the programs on this slide allow the cost of repair, rehabilitation, or remodel to be financed in the loan and can be done at the time of purchase or subsequent refinance. So if you have a property that needs a little bit of love and attention, it's still possible to get a sale going with that. Now, FHA has a disaster recovery loan, and it's a loan specifically designed to assist those impacted in presidentially declared major disaster areas. There must be a presidential declaration, which can be found on the FEMA website. Now, some of the advantages of this program are it allows relocation to anywhere in the US. The borrowers do not have to remain in the disaster area to use this program. So as an example, in the volcanic eruptions of 2018, if they didn't want to rebuild where their homes were, they could use this loan and move to Hilo or move to Maui or Oahu. They could move across the country to Virginia if they wanted to. Now, the borrowers are also eligible for 100% financing, and there are qualifying flexibilities. They're not required to already have an FHA loan. In fact, they don't even have to have owned the home they lost. They could be renters who lost their home due to the disaster and be eligible to use this program. Now, the one caveat is that they must apply for the new mortgage within 1 year of the disaster declaration. And no special approval is required of the FHA approved lender. As long as the lender is approved to do FHA forward mortgages, they can write this loan. So it's something to keep in your back pocket. Hopefully you'll never have an opportunity of a client that needs to use it, but it's there. So keep that in mind. Now, FHA's home equity conversion mortgage, or HECM, is a reverse mortgage, and it was conceived to allow seniors to access their home's equity and enable them to age gracefully in their homes. Now, the first HECM was endorsed in 1989 to a borrower in Kansas. The basic eligibility criteria for all borrowers is that they must be 62 years of age or older, they must occupy the property as their primary residence, and they must complete HECM counseling with a HUD-approved housing counselor. Now, there is a separate approval for lenders that want to participate in the HECM program. Unlike forward mortgages, the HECM program sets a single national loan limit regardless of location or number of units. Now, in 2023, that loan limit is $1,089,300. Now, also, please keep in mind that your borrowers can use a HECM to purchase a property. Now, we make every effort to be accurate, but we are only human. So if anything on the remaining slides contradicts our 4000.1 handbook, the handbook will always win in those cases. So just keep that in mind. So we're going to step through some highlights of FHA policy. And so you might find this interesting on how it may assist your buyers. So again, I mentioned this earlier, the lower minimum FICO requirement. 580, a minimum decision score of 580 will allow as little as 3.5% down payment and will go as low as 500, which will require a 10% down payment. But what if the borrower doesn't have a FICO score? They could still be eligible for FHA insured financing. And this would mean using a non-traditional credit report consisting of rent payment verification, utility payments, cell phone payments, regular payments made to a daycare, etc. And the borrowers could still be eligible for FHA financing. Now, borrowers may qualify with non-occupying co-borrowers and co-signers. Those non-occupant co-borrowers or co-signers must be U.S. citizens or have a principal residence in the United States. Now, U.S. citizenship is also not required. Borrowers do need lawful residency status. Now, certain non-resident borrowers may also be eligible with appropriate documentation. This mainly applies to DACA recipients and H-1B visa holders. Most loans, with few exceptions, must be run through FHA's risk evaluation engine, TOTAL, which stands for Technology Open to Approved Lenders. Manual underwriting applies to any loan that does not receive an acceptable risk classification or for any reason as determined by the direct endorsement underwriter or published guidelines. So we're going to take a look at some property issues right now. I'm sure most of you know condominiums must be located in approved projects or be eligible under the single unit approval process. 2 to 4 unit properties still qualify as single family residential properties. Now, if there's a 3 to 4 unit property, it's subject to a net self-sufficiency test based on the market rents as determined by the underwriter. Basically, the calculation of net rents after the vacancy factor is applied must be equal to or exceed the principal and interest payment calculated for the borrower. Now, I don't know if there's a lot of there's a market for manufactured housing in Hawaii, but this is the basic qualifying eligibility requirements for a manufactured home. Most notably is this is probably the only property where we require a minimum square footage of not less than 400 square feet. So now we're going to dive into credit and liabilities. So your borrowers may have a forbearance being reported on their credit report. Mortgages in forbearance that have no delinquency or missing payments are not considered delinquent. So even if they requested a forbearance, but they continue to make their payments in a timely manner, we considered that paid as agreed, regardless of the forbearance. Bankruptcy seasoning, it's generally 2 years since the date of the discharge. Now, if you have Chapter 13 filers, they may be eligible after 12 months under the repayment plan with a satisfactory payment history. Foreclosures, deed in lieu of foreclosure, and pre-foreclosure seasoning is generally 3 years from either the short sale date or the transfer date of the foreclosure or deed in lieu. Positive rental history. This is a new item for us. Positive rental history may be considered in the underwriting decision if the borrower and transaction meet acceptable criteria. And this is for consideration under our automated system. And it was announced in Mortgagee Letter 22-17. As long as the borrower is a first-time home buyer and meets the criteria listed, this could assist them be another positive point of assessment in the automated underwriting process. Student loan payments. I'm sure many of you have borrowers with student loan obligations. Now, student loan payments must be included in qualifying regardless of the status of payment. So that means even if the student loan is in forbearance or deferment, a payment must still be calculated for qualifying purposes. And this applies even to those payments that are income-based repayments, and they say your current payment is calculated as 0. Now, the lender will use either the payment as stated on the credit report, or if there's no payment stated on the credit report, they're going to use 0.5% of the outstanding balance to calculate a payment in which to qualify the borrower. Collection accounts. Now, if there are collection accounts with a cumulative balance greater than $1,000, the mortgagee must verify the debt is either paid in full with acceptable source of funds, or verify that the borrower has made a payment arrangement and include the monthly payment in qualifying, or include 5% of the outstanding balance in the qualifying payment. Charge-offs are not included in the borrower's debt or liabilities. Basically, if it's a charge-off, we don't need to know anything about it at that point. Now, there are certain obligations that are not considered debts, and the most common ones are listed here on this slide, but in no means is this to be considered an all-inclusive list. So, income issues. FHA issued several pieces of COVID-19 related guidance since the start of the pandemic. Several apply to the temporary loss of income, reduction of income, loss of employment, or hours worked. Exceptions were issued for several different types of employment and income types. Now, guidance addressed gaps of employment during COVID-19 and how long we want the borrowers to be back on the job for non-self-employed income sources. 1 month back in the same line of work, or 6 months back on a different line of work. For the self-employed borrower, we also issued guidance for income calculation, basically excluding the months the borrower's business was closed. Now, frequent changes of employment do not automatically disqualify a borrower. More than 3 changes in 12 months will require additional documentation. So there could be any number of positive reasons why a borrower would change employment with that frequency. So just because they change more than 3 times doesn't mean they're not eligible. Now, for non-COVID related gaps of employment, our requirement is a bit stricter. Gaps of 6 months or more require 6 months back on the job and a 2-year history prior to the gap. Income sources other than employment related are also eligible with the appropriate documentation. Again, this is not an all-inclusive list, but this is the most common sources of income. Above all, only effective income may be used in qualifying and must be reasonably likely to continue through at least the first 3 years of the mortgage. Assets, the show me the money part. FHA allows gifts for 100% of down payment, closing, and prepaid costs, regardless of the LTV of the loan. Conventional loans require investment of the borrower's own funds at higher LTVs. Gift donors are required to execute a gift letter stating no repayment is required. So who can give a gift? Family members, employers, unions, close friends, charitable organizations, and government or public entities with down payment assistance programs are all eligible gift donor sources. So family members, not everyone in your family is considered a family member, although it's a pretty extensive list. It starts on this slide and goes on this slide. The eligible family list continues. Of course, you might notice that cousins do not appear on the list. You can't imagine how many times we have cousins give sometimes very sizable gifts to their relative. By the way, that doesn't mean a cousin can't give a gift. Cousins fall under the close friends category and require some additional documentation. That goes for fiancés and parents of fiancés or fiancés. So that doesn't mean they can't, they just need to have a little bit extra paperwork involved. Family members can also give gifts of equity if they own the property being purchased by the buyer. Now, interested party contributions are costs paid by the sellers or others with a direct interest in the transaction, and that includes realtors. FHA allows up to 6% of the sales price, not to exceed actual costs, to be paid by these contributors. Now, secondary financing is any financing other than the first mortgage that creates a lien against the property. Now, this financing must meet our requirements and may or may not have regular payments. So this is a quick reference chart on the requirements and eligibility of secondary financing program. And this basically combines 20 or more pages in our handbook. It condenses it down to this handy reference grid. That's not to say that this takes the place of the guidance in the handbook, but it's a handy reference and it'll give you a great starting place. We don't recommend you take anything on this slide at face value. We're just highlighting a particular point. You have to read the handbook to get the entire scope of the guidance required. Now, mortgage insurance premiums. There are 2 types of mortgage insurance premiums. The first is the upfront mortgage insurance premium, or UFMIP. This is a percentage of the base loan amount, which can also be financed on top of the base loan. The current percentage is 1 3/4%. So you can take your 96.5 calculated loan amount, multiply that by 1 3/4%, and add the full dollar amount on top of your loan and finance it. That's the advantage of FHA, one of the bigger advantages of FHA. Now, there are a few exceptions to the 1 3/4%, and Indian land loans do not require a UFMIP. Now, FHA also collects an annual MIP, which is collected monthly with the borrower's monthly payment. Rates vary depending on the term of the loan, LTV, and loan amount. Hawaiian homelands are exempt from the annual MIP, which will become clearer on the next slide. Now, on February 22nd, FHA announced a reduction in the annual MIP rates. In the past couple of years or more, the question of whether FHA was going to reduce the premiums was the most asked question I've personally encountered. Now, the reduction in these rates is estimated on average to save the borrowers $800 annually in payments, and could mean the difference between them qualifying for the loan or not. Now, the programs on this slide have different upfront and annual premiums depending on the type of loan. So take a look at the Hawaiian homelands premiums. It's most commonly 3.8%. So the lack of an annual premium becomes evident. I'm going to quickly go through some resources for you. The first link is to the Single Family Housing Policy Handbook 4000.1. And this is the single source policy document for most of single families programs. We are awaiting the highly anticipated publication of the HECM portion of the handbook, which will just about complete consolidation of over a dozen separate handbooks. Now, the mortgagee letter link will take you to mortgagee letters, which announce policy changes in between handbook updates. And finally, the link to subscribe to the FHA info bulletin. This email announces mortgagee letter publications, handbook updates, waivers, training opportunities, and even job openings with FHA. And it's the best way to stay informed about what's going on in FHA. Now, the FHA Resource Center is your best source for answers to your questions. First of all, we have a FAQ database, which has thousands of FAQs in it. And you can go to www.hud.gov/answers, and this database is available 24/7, 365. Now, if you have case-specific or policy-specific questions, you can send us an email at answers@hud.gov, and you can email us 24/7, 365. Now, you can also call us at 1-800-CALL-FHA or 1-800-225-5342, Monday through Friday, 8 a.m. to 8 p.m. Eastern Time. They will try to answer your question, and if they can't, they will escalate it to the appropriate homeownership center or office that can answer your question. Now, this QR code will take you to the page shown to the right, and you can click on the topic you need, kind of like a one-stop shop. So please keep in mind that this page is not an official HUD page and is subject to change without notice. But if you know, you can access the single family housing main page, housing handbooks, FAQs, mortgagee letters, the Office of Housing Counseling in case your borrowers need housing counseling, the link to subscribe to the FHA info bulletin, the link to look up if your condominium project is approved. For those of you interested in HUD-owned real estate owned sales, it's the HUD Home Store link. But I will tell you, there hasn't been an REO sale in Hawaii available this fiscal year. Single family also puts on webinars, training webinars, and they record them and post them on the webinar site. If you're looking for a HUD approved lender, you can search one out by going to the HUD lender list. And if you want to verify FHA mortgage limits, which I highly recommend you do, it will take you to the page to find the mortgage limits for Hawaii counties in Hawaii with that link. So that concludes the formal presentation. I want to thank you for your time. And I believe we have time for questions if you have any.
Hey, thank you, Esther. That was very informational. I wanted to double check with Esther because she's looking out for my
Yes, so
questions. Do we have any questions?
we have
there?
no questions at this time. Anyone out
Okay,
there
well,
in the audience? I guess not, huh?
I know that was a
yeah.
lot of information packed into probably a short amount of time, but I will make the presentation available to Ramona so she can forward it to you, and
Okay,
you can get it sent out to your membership.
wonderful. And then if we need to, can we refer any questions, follow-up questions to you, Esther, or you want that to go to Ramona as well?
We would probably prefer that they go to the FHA Resource Center,
Oh, okay.
but as a last resort, if you send them to Ramona, she'll get them to me.
Okay, no problem. Well, thank you, Esther. We want to thank you for your time today, as well as Frederick Griefer and Ryan Okuhara. Thank you so much for giving us the education on the update of FHA, and we appreciate it. And we will say goodbye and have a wonderful day. Thank you.
Great.
Aloha.
Thank you for having us. Bye-bye.
Bye-bye.